Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Dennis Davitt has spent more than 3 decades in option markets. Getting his start in the crude pit on the NYMEX, he soon thereafter moved to equity derivatives, a product he's run risk in across both the sell side and buy side through many cycles. Through our conversation, we learn of the strong appreciation for liquidity, especially as it relates to dynamic products like options that Dennis has gained through the many vol events he has traded through, especially during his long tenure running equity derivatives at Credit Suisse. In his rendering, it is from these episodes that we see 2 consistent outcomes emerge. First, that investors become overleveraged, and second, that books wind up mismarked in some way. Here he cites the concept of liquidity delta, a metric that incorporates the impact of one's own presence and that of similar participants in markets. Impressed by the efficiency of prices in U.S.-listed option markets, Dennis sees little obvious opportunity to extract arbitrage profits. Instead, he looks to option markets as a vehicle to produce an intended risk outcome. And here, we shift to the work that Dennis is doing as CIO of Millbank, Dartmoor, Portsmouth, a firm he founded in 2020 to provide a risk-managed equity alternative through an options overlay. We explore the factors driving the flat skew in S&P 500 options as Dennis contrasts today's setup versus that which drove the XIV blowup in 2018. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Dennis Davitt. My guest today on the Alpha Exchange is Dennis Davitt. He is the CEO and CIO of Millbank, Dartmoor, Portsmouth. Dennis, it's great to have you on the podcast today.
Great to be here, Dean. I've been looking forward to this.
Yeah, this is going to be a lot of fun. We'll do some history, some retrospective on the change that is always afoot in markets and maybe specifically equity derivatives. We share some common lineage. And of course, we're having this conversation at a pretty interesting tipping point, at least potentially for markets, what with the big sell-off in the long-dated bond markets and some of the FX volatility. So there'll be a lot to talk about. I figured what we do is start with your career history, just get to know you a little bit as a participant in markets. Tell us about how you got started in this wonderful world of high finance.
Yeah. The key to my getting a start in the wonderful world of finance was my height and size. Back when dinosaurs walked the earth, I got a job as a runner in New York on the crude oil exchange, where I used to, physically run the orders into the pit and do the hand signals and everything. And I did that for about a month in the futures pits. And then I realized that there were options pits out there that I found a lot more interesting. And none of the futures guys wanted to work in the options pit because options traders always complain about their futures fills. So that was how I got started. But I was very, very fortunate to fall in with a group, and then I got hired into what was an O'Connor spinoff company called Czar Trading. And really the best, most concentrated options, knowledge base that you could get in the floor trading community was from those former O'Connor guys, the Susquehanna guys, Cooper Neff, some of these firms, I don't know if they're around anymore. But there was a real intellectual curiosity, I like to say, where you were developing new models, very kind of nerdy and brainy on one side, but you had to actually physically go into the trading pits with your trading sheet and trade around. From there, I went to Chicago and had the good fortune of meeting up with Rob Bellick and Chris Gustin when they first launched Wolverine Trading. And that was really took all of my options knowledge to the next level. Trading in Chicago, being an SPX trader with them for 10 years was probably the best education you could ever get. Probably can't be replicated anymore either because a lot of those big trading pits are no longer with us. I view my career on the street as kind of 3 different phases. That first one being a floor trader. The second one, when computers, eventually took over, they weren't a fad after all. And electronic trading took over. I had the ability to move upstairs and take a job as a trader, a risk manager at Credit Suisse. Credit Suisse, they just rolled back Glass-Steagall. Credit Suisse had merged with DLJ and First Boston. So it was a great mixing pot. Great place to be. I was there for 10 years up through 2010. And when I left in 2010, I was head of equity derivative trading for the Americas, which was a really neat job to have. Once again, continuing to look at falling back on a lot of what I learned at Wolverine and learning new products. Then it was like being a floor trader, an index trader, a commodity options trader, fixed income options trader, because Wolverine was growing. And then at Credit Suisse, I had all of these new areas that eventually I started working with. So that was really great. Where I'm at right now is more on the asset management side. I worked at Harvest Volatility Management for about 8 years. And then 2 years ago, I left there and started MDP, Millbank, Dartmoor, Portsmouth. And the goal here is to use option strategies to achieve a goal. I often get people disagree with me because I don't see volatility as an asset class unless you're a market maker. I see it as a way to achieve a goal. And the goal we try to achieve here is just a hedged equity return. I've seen a lot. I've seen it from the standing on the floors to waiting in the waiting rooms at large pension funds and endowments to go and talk about what we do for people.
With respect to vol surfaces, I really agree with you. I think that you might be some high frequency engine, just fully stacked from a computing standpoint, and you've got all the math figured out and you're processing price quotations at blazing speed. Maybe there's some arb there, but the old days of kind of finding rich or cheap vol is pretty skinny, to say the least. And I really would concur is that you want to try to use options to achieve an outcome. So we're definitely going to talk quite a bit about the product that you're creating on behalf of your clients. As you were doing your intro, they just gave me so many ways to take this, just both through time, through the evolution of how liquidity is transacted. Maybe we'll start with time, because you spent some time in the 90s exploring different markets. Crude was one of them. You were a market maker. And so this was pre some of the epic crisis events that we ultimately would have, whether it was long-term capital, of course, the big one in 2008, maybe the pandemic is short-lived, but pretty violent. What are the learning experiences that someone like yourself takes away from these epic dislocations where the VIX is blown well through its previous all-time high and things are just gapping out? What are the takeaways from someone in a risk-taking seat from those big seismic events?
Well, it's kind of like the sun will come out tomorrow and there'll be another vol event tomorrow. Before we did this, I didn't even use the internet. I just sat down and I was like, well, what are some of the vol events that we've had? And I came up with like 16, everything from Orange County to LJM to TVIX. Bernie Madoff got attributed to being, a vol, even though he never traded an option, he had made up options trades. He's still the black guy for the business. And first thing we really do is there's always going to be another vol event. But oftentimes what I try to boil down to, I get asked this question a lot. And there's two things that consistently come to the surface about these events. One is leverage. People tend to get over leveraged. And then the byproduct of being over leveraged is you have mismarked books. So not having a valuation of an asset on your books that is accurate to liquidate, you really, what the old days people would say, you put a ticket in a drawer, you never book it, and you hope the next day that the market goes your way and you get out of it. I mean, I can go back to the first part of my career where you would buy some calls and you would go to sell futures on a limit order and you'd miss it and you'd chase them, and then you wait till the next day and then chase them down again. That was in essence a way of mismarking a book. And then you can take it right up until a few months ago with the Archegos issue, when everybody had all of these non-recourse loans on their books that were probably not marked in the proper way. And then you can take it a step further to managing what the risk is on your books. I mean, I've told the story many times. If I found a doctor that told me that I could eat a cheeseburger every day and nothing would ever happen to me, and then if I took this one pill and, you do it every day and 10 years later, you're obese and have a heart attack. And as you're dying, you look at the doctor and say, but I took the pill. And he goes, I guess I was wrong. You need to know what risks are in the books. And oftentimes I tell people, if someone says that they have a tail risk or a long volatility fund or something that carries flat, you'll get all this convexity to the downside, but it won't cost you anything. You're usually short some sort of kurtotic risk or some sort of wing risk in that portfolio somewhere. And that can manifest itself in counterparty risk, and all sorts of different things that people have in the books. Because like you said, the markets are so efficient right now. It's tough to find that the history of options trading where the guys who made tons of money in the early days were just doing conversion reversals. And it was a true arbitrage. And that has morphed itself 40 years later into, like you said, high frequency trading and between different exchanges where people have fiber optic cables and straight lines between exchanges. There's always going to be somebody faster. That's one of the issues around this. So I find that if you give up the edge that you have to give up to enter into a position now that could be beneficial to you is about as tight as it's ever been, depending on how much size you need to move in the market.
A couple of really interesting points there. And you talked about mismarking. Perhaps it's marked to model. And so it's marked to some imaginary number that got spit out of a complex equation that might not necessarily be realistic in terms of transaction. But even Archegos, it's an interesting one. I wanted you to reflect on this because in some ways they have equity swaps. They're really marked to the close. So that's not necessarily mismarked, but it's certainly mismarked relative to the crowding that probably should have been known, right? In other words, the market's capacity to bear an unwind of all of the swap counterparties in concert was certainly mismarked. And I think that's an interesting concept. And just, I'd love for you to talk a little bit about episodes of crowding throughout your career. Certainly 2017 was a pretty darn good episode of crowding. We might put long-term in that category as well. When you think about crowding in terms of risk management, how does that make its way into your process and framework?
I used to just throw around a term like liquidity delta, like U.S. Treasury bonds. People always say Treasury bonds are the most liquid thing in the world. And I would say, well, not for China, right? Like if they come in to dump their bonds, there's an elasticity to it. You need to right size what you do to the market that you're in. And, we used to do large, and they still exist now, large corporate trades exist in the banks. And, they could be either accelerated share repurchases or big corporate trades. And you would have this dilemma where you would have a short, at times, more often than not, you have a short gamma position on, and you looked at the single stock and you're like, well, if I get back to delta neutrality on this, I'm going to drive the stock down another 5%. Stock down 10%, I got to sell $40 million of the stock. If I sell $40 million of the stock, it's going to go down another 10%. I'm going to have another $40 million of stock to sell. Those are, the ways around that liquidity-wise in the past, and that was kind of importing a lot. And I worked with some brilliant people at Credit Suisse with this too. Credit where credit's due, a guy named Rob Sowler. We would look at this and you just reserve stuff on the front end of the curve, where how much money are you really making on this trade to this theoretical value? And then that buffer, that ability to release assets against it, oftentimes could manifest itself in the form of a delta. But yeah, liquidity, especially today, not to be too calendar specific, we're coming into the end of the month. The end of the quarter. At the end of the quarter, there's a big options trade that's all going up that all of us know about. Crowded trades, it always reminds me, like in my history, we used to do these trades, these iron condor trades, these short call spreads and put spreads. And this was, I'm going back to 2003, 4, 5, 15 years before they were super popular with one person. And the ability to deal with what people thought your position was in the marketplace. And by that, I mean is back then we would have these trades on and we would trade them OTC. And then we kind of back-to-back them with the floor, some of the position. Sometimes we would do more. And then I would hear nothing but I would see research reports and you read in the Wall Street Journal about this big position. There was no position. There was no financial motivation behind doing that position outside of laying off something that we traded OTC. As far as liquidity, you need to know what's going on in the space. The pipes and how things are traded is very important. But only recently with this current situation where you can actually look at what somebody has to do and knowing that they're going to do it in the current marketplace that's out there. I have not seen that in 30 plus years in the business. I haven't seen this telegraph to trade ever.
As you look back on your many years providing liquidity, that part of your career in terms of roles at a place like Credit Suisse, and you look at the electronification of liquidity, screen-based liquidity, maybe not in giant size, but sometimes in pretty large size on at least things like the big liquid ETFs. What has that meant just in terms of if you go way back to before screen-based transparency and execution was a thing? Walk us through the evolution of how liquidity is provided and what that has meant for risk management considerations.
When it comes to liquidity, one of the things I always go back to, I remember we used to trade in eighths and sixteenths in options. And you need to allow a pool of people to make money. And what I mean by that is you want to have, for true liquidity, you need a diversified pool of liquidity providers. And I think what we see nowadays is a concentration of liquidity providers in, say, 3 or 4 major liquidity providers. And it tends to all be clustered around the most liquid index and ETF options. That's really a shame because, single stock options and being able to move, and not even a very large size. And for what it's worth, I don't trade these anymore. I'm not active in single stock options. I'm active in some ETFs, like an EEM or an EFA. And even there, liquidity at times can be frustrating to move something. I always say it's like you have to let people make money. All the money being made, like being concentrated in one area, I find can hurt overall liquidity. And that was really the elimination of a wider bid-ask spread. And another story was back from 2000 to 2010, the banks provided a lot of liquidity. I remember your guys' desk provided a ton of liquidity in single stock options. But then it got very difficult because the hedge fund community would look towards the single stock options and say, well, the screen is 3 cents wide and I need to be filled on the screen. The demands that came out of the hedge fund community in that time period of the banks, as the banks were competing for order flow, allowed them to trade on completely inelastic prices. I would get in trouble because it was a big client. We had to put the client up and we would sell them an option, let's just say at $2.10 because the market was 207 bid at 210. And you'd sell them an oversized amount at $2.10, where realistically the price at 215, 216, you could find liquidity. Then we would just go back into the market, buy the option back at that price, 215 to 216, and be out of the trade. Because it was silly to put the trade on for the commission dollars created. We would have wound up losing significantly more. I just remember the clients would always call me back and be upset because they said, well, I've showed the whole street what they're doing, or I've moved all the screens against them. And I'm like, well, the screen should be moved against you. You just bought 20,000 options on the offer. You don't think the offer should be higher now. That's like the true market making skill set. Tell you something at 210, and now my market is going to be 208 at 212 for a commensurate size. And it goes back to what I said. If you only have 3 people streaming those markets, you're going to go to buy it at 210 now electronically. You're going to get 600 options done, and then it's going to completely shift. It's really a very skittish marketplace in volatility now. And we're moving into maybe equity vol won't be as volatile as it has been. Maybe all the volatility monkeys will go over to the fixed income side because they're certainly seeing fixed income and currency volatility is trading really high, and everybody's saying why isn't equity vol higher? I actually think equity vol is very fairly priced right now.
I think you're alluding in some ways to the winner's curse sometimes. That certainly is an issue on the sell side where you're providing liquidity. You don't know exactly what the cover is going to be. You want to win the business, but you don't want to win by too much. And sometimes the only way to win is to take a loss. What's that balance? What was that balance like in terms of managing a client franchise, obviously having a fair amount of prop risk, either intentionally or certainly as a residual to the trades you were facilitating? How did you balance being aggressive enough, but not too aggressive?
You really need somebody who runs the business, who understands the business in total. When I first started working upstairs at Credit Suisse, and I was kind of like, all right, there's going to be a loss ratio with certain clients, that you're going to lose money to this client, but you're getting paid somewhere else in the bank, which was, for a guy from the floor, was completely foreign to me. My job is to make money. That's the article I wrote or I was interviewed in that said, there's no such thing as alpha. I always saw myself as an alpha producer. I rub two sticks together and we make money trading options. We're buying and selling different things. So I did that for a year. And at the end of the year, you got paid bonuses. And you got a terrible bonus because you didn't make a whole lot of money. And then you would look over and say, but look at all these happy clients and look at our Greenwich rating. And then it would say, well, that's the relationship that the sales guy had. So then the next year, we decided, I was a little bit more senior, and I was able to say, well, we're going to put the P in prop trading. And if clients are going the way that is beneficial to us, that'll be great. If they're not, we're just not going to be competitive in the pricing that they're looking to do. And there's a lot of really smart people out there. So smart people all want to buy the cheap options and sell the expensive options. So we just would not find ourselves in that situation. And our commission run was terrible. So then trading got a bigger bonus than sales did that year, but it just wasn't a healthy environment. And what you really had to do, and what I found worked best for me, and I don't even know if you can do this anymore. I mean, I've been out of that side of the business almost 12 years now. You need to be really good at prop trading, and then you need to develop a relationship with the customers where you would have them call you up and say, hey, I just saw you put this trade up. I always use the expression, what's the financial motivation behind that trade? And then they would see it, and then they would almost partner with you on those trades. We'd have clients come in and do something. We would take down the whole side of the trade. Then other clients would call up and say, that was really good. What are you doing to hedge that? And you would explain to them. So then you would kind of find partners in liquidity. And then that way, you're collecting commission on all the stuff where the people were partaking in your trades. And then the other side was, if somebody came in and they wanted to just buy, say, outright puts on a biotech stock the day before a ruling came out on copyright, a patent ruling, that's an incredibly risky trade. You'd get on the phone with the client and say, what's the financial motivation on this, right? What are you looking to do? Well, we're long the stock. If it breaks down 20%, we would buy more down there, but we don't want to buy any more up here. It's like, okay, well, that's a put spread. And I'm more than happy to sell you a put spread because if the stock breaks down 50%, as the desk, you're going to wind up making money being short that put spread because you're going to have short delta on as a hedge. And both sides win. So it's coming to rational meeting of the minds to achieve the profitability for the desk and then reputationally. And then there are guys you'd ask them the same question and they would say, shut up and make a market. And then you say, okay. And your market would be really wide. And you find that they would just call you less and less.
Yeah, I always found that an evaluation of the client was an important part of getting the trading side on board. There had to be good connectivity between sales and trading. And at least in the early days, I found that sales was sort of this, I pick up the phone, I get the order, I take the order, I give it to the trader, I relay the pricing back, and that was kind of the end of it. And I thought, well, there's got to be much more of a joint evaluation of the trade. Ultimately, it's going to be on the trader's books, and that person is going to carry the ultimate decision. But there should be some greater involvement just in terms of what's this trade mean? 3 cents commission is not a lot relative to the amount of Greek risk that's often taken in these trades. So,
and as I said, you need to have an understanding of people that are senior. And, back in 2000, when I first started at CS, we had senior people that were not derivative savvy. And I'm not saying that in a derogatory way, but they would come in and say, you should be putting up this, notoriously bad hedge fund. You need to put them up on trades because they pay us this much on the cash desk. And I said, okay. But you realize the trade that I said no to that they're really upset about, that trade just lost $15 million. So how much did they pay us in cash this year?
Right.
It was never as big. So it was really educating them to say, at what levels do you want to really do this business holistically? Like if we're going to look at the business holistically, let's really look at it holistically, not dump a bunch of risk on the derivative desk so we can collect stuff on the cash desk. And that changed, eventually there was a lot more transparency to it. And then the ability to take risk on a lot of the derivative desks is significantly less than it used to be.
Let's shift to a discussion a little bit more of the here and now of pricing and then the options as a vehicle of achieving portfolio exposures versus some arbitrage play. So why don't we first start with the founding of your current firm in terms of your business idea? We'll weave into it all the geeky stuff on vol skew and things like that. But tell us about the founding of MDP.
I spoke about, I was at Harvest Volatility, and Harvest was going to be bought by Victory Capital out of out of Cleveland. And the deal didn't happen. December of 2018 happened, certain things happened, and the deal did not take place. At that point, I am down here in Asheville, North Carolina. We decided to go our separate ways. I knocked around for a bit, tried to figure out exactly what I wanted to do. I actually worked, in full disclosure, I worked at Malachite for about 3 months. I started there in January of 2020, and in March of 2020, Malachite was no longer. So then, there's a good 3 or 4 months of soul searching about how we want to go about this. And I was, fortunate enough to be spending time with my current partner, Mike McCarty, talking with him about what I wanted to do and how I felt that, especially on the back of Hamilton Reiner's success with his JP Morgan Hedged Equity Fund, which is very similar to what I had been doing at Harvest, I kind of wanted to start my own firm and do it out of Asheville, North Carolina. And that's what we did. And Mike has been a longtime friend of mine, and he was a guy who first introduced me to Erin Burnett and got me on TV for the first time. And before we even worked together, he introduced me to one of my first big institutional clients. We've always been like competitors, co-workers, and more importantly, friends. He's also good friends with Richard Devoso and Mike Novogratz. So their family offices, we went and spoke with them about this business. And listening to this podcast, you probably know who Mike Novogratz is. He's actually been on this podcast. This is a different type of business from him. This is not crypto. This is more of a using options to achieve a hedged equity return. So lower volatility in your long equity bucket. And we do it by using options. When I first started doing this back in 2013-14, we would just ask people routinely what's in their portfolio that you don't like. Because when I asked people what they wanted, they always gave me a laundry list of impossible things. And then you'd have to say, well, these things are impossible. And then they would say, well, the person who was in here before you from Infinity Q said they could do it. And you're like, well, that doesn't make sense. But what I realized is asking what they don't like in their portfolio was the much more powerful tool. And back then, they would say they didn't like long-short equity hedge funds. It was right after the financial crisis. They didn't really give them the protection to the financial crisis they had hoped for. And then with the market's rebound, they really didn't participate in the rebound in the market either. Taking them and what else they didn't like the cost, they didn't like the investment drift, they didn't like a whole laundry list of things that they didn't like. So now you're getting all this information about things that people don't like. So you need to design something that is the opposite of what they just described, which is easy to do with options. I mean, if you're looking for a long short exposure and you create your short exposure, I mean, even recently with Melvin Capital and the meme stocks, if you have a well-constructed short equity exposure with options, you're never going to have to worry about being bought in. Your long-short balance is in line. It's very predictable. It's very manageable if you don't institute a lot of leverage into it. So that's basically the crux of what I do. Fast forwarding to now, when I ask that same question, it's from January of this year, it's like, what's the replacement for 60-40? What is the negatively correlated asset to my equity portfolio? I mean, for the first part of the year, it was energy, like as an inflation hedge. It certainly isn't bonds. I mean, that's pretty well known right now, and it had been for forever. The only thing that I can look at that really worked this year was if you got long the dollar. And I don't think there were a whole lot of portfolio managers who started out the year saying, I'm going to get long equity, but my hedge against the long equity is going to be a massive long dollar position. I just don't think that was out there. And who knows how much longer that's going to work. I mean, if the dollar turns back around and equities don't recover, what's your hedge? Whereas what we're doing is putting an options hedge that is negatively correlated to the underlying market.
Yeah, ultimately, the only true hedge is one that you've actually expended premium for. And we can argue as professionals, and I think this is where the analysis comes in, is the price worth it? You can pay more or less for hedges over different periods of time. And sometimes, at least on an ex post basis, they wind up being either a bad deal or a good deal, but the only real insurance is one that you've paid for. You can use proxy hedges, things that appear negatively correlated to the stock market, and you reference the bond market, things like the dollar. Those just aren't guarantees. I think that's the key. And then, to your point about this idea of the flat carry, but I'm long convexity, there's something not exactly intellectually honest about that. It doesn't mean we can't keep looking. We should always try to find some way to defray cost at the right price in terms of accessing convexity. But say you've found the fairy dust of the carry-free hedge is just a difficult one, I think, for a lot of us to stomach.
There's three things that I think about in terms of what you just said. One is the basis risk. Oftentimes people say, what's the next tail risk event? I'm like, I don't know because it hasn't happened yet. We've had horrible things happen that are tail risk events. If you repeat that horrible thing, it's not really going to be a tail risk event because you've already seen it. So what the basis risk is on what your hedge is against what is your tail risk event. I was talking to somebody the other day and they were like, I go, what is your tail risk event? And they're like, I cannot pay the pensioners. I need to be liquid to be able to make payments, which is a very common thing right now with people pushing into private equity and calls on capital that may happen if the markets roll over. So basis risk, what that hedge is to what your underlying asset is really paramount. And that's where a lot of these like flat carry things exist, where people take big basis risk. They make assumptions that are not necessarily true. The other thing is in a long vol hedge where you're owning some sort of put, the market can do three things. It can go up, it can go down, it can go sideways. Well, 2 out of 3 of those scenarios, you're going to be losing money if you have a true long put, for lack of a better term. The question is, how do you eliminate some of the bleed in 66% of the scenarios, sideways and up? I think people preoccupy on that almost a little too much in a lot of the tail risk space on equity side right now, because we have tail risk hedges with the market down 20% this year. They're tail risk hedges that are down on the year, which I get it. People may say that we grinded down slowly. This wasn't a tail risk event. This wasn't March of 2020. But I would think if we're down 20% and I invested in something that's a tail risk, it would at least be flat to slightly up. Once again, I'm concerned about somebody who invested in a derivative strategy that was a tail risk and it wound up costing them 7% with the market down 20%. It actually added to the loss that's being carried in the portfolio.
It's a tremendous result. It's an unfortunate result. It's kind of a head scratcher. I mean, if you just look at, I also agree, you've got the controlled drawdown for the most part. I mean, when something goes down 23 to 25%, it's hard to call it that controlled, but all things considered, we've chopped through a lot of S&P index points relative to realized vol in the year is only 24. Again, that ratio of drawdown to vol is pretty low in terms of the amount of vol we've had. Why do you think, and I'm just asking you to think out loud here, but if owning a put is protection in kind of two ways, there's obviously the delta part, but you would hope for a little bit more vol expansion on a drawdown of this magnitude. And if you just look at specific strike options, the 3,500 strike put or these types of things, it just hasn't really seen its fair share of vol expansion. Any thoughts on the why of that?
Yeah, and this is my speculation on this. I'll say this is not ground in fact, but being a market observer for as long as I have been, part of me is like, I want to go to a bunch of people and scream down the hallway, hey, 2018 called and they want their trade back. Everybody had the trade for Volmageddon where you really did not see the equity market sell off as much as you saw vol expand. That was primarily due to people sourced their long volatility by being short the SVIXY, the SVIX, the inverted triple short VIX, the one that went from 28 to 0 overnight. That was a source of long volatility that a bunch of uneducated people had that position on. And I don't mean that in a bad way. There was an ETF that existed and people owned it, and they were getting 70% returns when the VIX was at 9 or 10. VIX around 11, and you're still making 80% a year. Like, there is so much leverage in that product that should have been disclosed and wasn't. But that was everyone's source of long volatility. You can't replicate that today in that instrument. The closest I think you can come to replicating that is by buying calls on the VIX. So if you're long calls on the VIX and you need to, going back to my 2 out of 3 scenarios, you lose money, you need to kind of finance that position. I always laugh. I'm a simpleton, right? The VIX moves on 100 vol, the VVIX or something. And S&P moves on like you just said, a 24. Owning options on an asset that moves on 100 vol versus being short options that move on a 20 vol, over time, if your delta is not correct, if your ratios of your long 100 vol assets off, and you think about it just from a vanilla point of view, you need to be short a good amount of vanilla downside options to help finance that long upside call. Going back to what we said earlier, crowded trades. There's no fixed gearing delta on the VIX. So there's no guarantee that if the market's down 20%, that the VIX is going to be up. It should, but it's not guaranteed. If the market's down 20% and I'm long a down 10% call, intrinsic value is going to come through. If it does not, you're going to be up 10% on that call. You'll probably be up more because of the vol value of it. Very simple way of looking at it. I just look at it and I think everybody's trying to recreate that trade of Volmageddon and look for that VIX exposure. And I don't see it happening. When I was my days at Credit Suisse, we would do a lot of VAR versus vanilla stuff. You would own variance or be short variance, and it was all dependent. You could make your theoretical value of variance was dependent on how much of the curve that you took in. If you took in down 10% of the vanilla curve, you would come up with a number. Say at the money vol and S&P's 20, if you took your skew characteristics and you went down to the 10 delta put, you would have a variance value of 24. And I'm just making these numbers up. Please don't email me and tell me I'm wrong. But if suddenly the traders started saying, wow, I'm short $2 million of variance versus being long $2 million of vanilla, and I have, $1 million of profit. And I'm like, okay, well, we need more edge to put more of this position on. So let's move it from taking the 10 delta put down to taking in the 5 delta put. Very simple thing. And as you included that further down put, you increase the theoretical value, right? So the edge would go away. And what it would do would make you have to, no one on the street would do that, or maybe other people on the street did it. But we would then have to acquire more edge, for lack of a better term, or more alpha to increase the size of that position. Consequently, if somebody came in the other way and started selling it back to us, and we got long a bunch of variance, then we just start moving the downside put delta up to as high as the 20 delta put, just to kind of control that spread so you could, really have a good idea instead of just fixing it and saying that's where it is. I don't think people are doing that now. And not that they're trading VAR versus vanilla, but I think they're trading a lot of VIX versus vanilla products. And it feels to me, and the price action's been that way, that the VIX is not popped, for lack of a better term. I also think there's a lack of leverage in the market. I said to somebody the other day that nobody does an opening trade on the VIX at 40 or 50 or 60, right? That's invariably somebody coming over and saying, you've been short the VIX at 30, it's now trading 55, you're out of business. We're just going to go to the marketplace and cover your short. So without that short in the VIX, without that kind of those sorts of products in the market, and they're not out there like they used to be, it's really hard for these things to blow up.
Yeah, I think you make a great point on number one, the sort of overall degree of exposure. If you look at data coming from prominent prime brokers, you'll see grosses and nets in pretty low percentiles. And certainly the VIX ecosystem is very, very small versus where it was at the beginning of 2018. I thought what you said on variance and just the incorporation of lower delta puts was interesting and certainly something I quite remember in competing against guys like you back in 2002 and 2003 and 4 and so forth. I wanted to use that to motivate a discussion on skew, on vol skew in the S&P, because it's really interesting and I think it ties into your risk-managed equity product. You and I were talking the other day about your old CSFB index, Credit Suisse Fear Barometer. This thing is at a multi-decade low. It owes to a number of factors, but if you wouldn't mind, I know a lot of our listeners are going to know what this index is and what it calculates, but it would be good for you to describe it. And then it'd be also great to just hear a little bit about how this vol skew makes its way into your process in terms of the product that you deliver.
The Credit Suisse Fear Barometer, and credit where credit's due, I co-created that with a guy named Ed Tom, still in the business, working at a hedge fund right now. It came from many phone calls with people trying to ask me where skew was. And a lot of times, we would use variables in modified quadratic equation to figure out the slope of the line, or some people would say it would be the spread between a 30 delta put and a 30 delta call. And then other people were like, well, you take that and then you divide it by at the money. There was many different explanations on how people arrived at whether or not skew is steep or not, as there were incoming phone calls. So one day, I realized that we were doing all this business of pricing zero cost collars on single stocks. And everybody knew what a zero cost collar was. If I sell this call, what put am I buying? Or if I buy this put, how aggressive do I have to be on selling my call? And this is at the height of people trying to hedge out internet positions in post 2002. We just sat down and it's really, really simple. It just says, if I sell a 10% out of the money call in the S&P 500 with 3 months to go, how far out of the money is the put going to be? And if skew is zero, it's roughly going to be 10%. Now, I know there's forward and I know that there's dividend, but we're talking about a 3-month forward. So it's not that much of an influence on the percentage of out of the money. It does get the message across to people and really sometimes how you don't want to sell calls. It is traded as high as 40, which means if you sell a 10% out of the money call, you're not getting any protection until the market is down 40%. And that just kind of got the message across to people about where skew is. The way we incorporated it, and it was how readily it was adopted by our clients at Credit Suisse, and they still publish it today and they still use it. It was kind of funny. I would be at places and people would start explaining to me that they knew the guy that created the Credit Suisse Fear Barometer, and I would just kind of nod my head. It's an easy way to understand what skew is. The thing about VIX and skew and what we do at the firm is, and to put it in really straightforward terms, an efficient option hedge with the VIX at 32 is going to be dramatically different than an efficient option hedge with the VIX at 12. And the same thing can be said for skew. When you want to be overwriting call positions or when you want to be buying put spreads or just outright buying puts is also dependent on skew. It's the two biggest factors in forming a vol surface. We can go into kurtosis and all kinds of other fifth moment stuff, but for the most part, it's volatility and skew. How high is the curve? How steep is the curve? You tell people it's like a seesaw, right? Your VIX is where it's rotating around and your skew is the steepness of, do you have a fat kid on one end and a skinny kid on the other, or how steep that seesaw is going to be, and how high off the ground is the VIX. That simple analogy really gets people comfortable with rotating on a monthly basis between different option hedges. Instead of just saying, nope, this one option hedge, this is all we're going to do all the time. But you don't want to overcomplicate it. For this podcast, people may be like, I tuned in for this because this is a sophisticated podcast with a lot of option talk on it. But in facing the retail market with our mutual fund and our institutional market with our large SMAs, people really get their head around it. And then you can outline it with people and say, if the VIX is here and the CSFB is here, this is a sample portfolio of what I would have on. And then they say, okay. And that eliminates what I mentioned earlier about investment drift. It's hard to predict the outcome of a volatility arbitrage firm.
There's an old adage, I think, in vol markets, take what the market gives you. Sometimes nothing's free. There's nothing incredibly obvious these days, but there are times when the vol surface is either affording you to do something or it's dissuading you from doing something. And this notion of skew that you talk about, I think, is just so interesting. To me, there's kind of two things going on. One is there's just a natural demand for insurance against that which is widely owned, which is US equities. So that's the first. And then the second thing is if we just look at market behavior, 87 crash, LTCM, all the big risk offs, obviously the GFC, those are market shock down events. And so realized skew is something that tends to be the case, that realized vol on down days is larger than realized vol on up days. Maybe the meme stock episode is a glaring exception to that. But it's just, to me, interesting that the surface right now pays you very well for this out of the money call. And, if I look at this year, the realized vol of the S&P on up days is about 23%. So, of course, that's higher than normal, but it's going to be higher because vol is higher. You're going to get your big up days in a volatile market. Those are the recovery days. But it's a head scratcher to me, and certainly lines up very well with your product that you get paid so well to be short this upside call against the protection that you want.
And what I found is when you and I have this conversation and we say, why is skew so flat? And this is something that we lost during the pandemic. Being able for me to jump on a plane and fly up to New York and go out with a bunch of different people and just kind of form the volatility mosaic, talk to different people. What do you think? What do you think? And then also talk to people that are outside of the vol circle. And for this, what I've realized is there's a real fear in asset manager land about a real whoosh down in the market. And so many people were coming out of this low yield environment. A lot of people had to push into, now mind you, this is all speculation on my part. I think a lot of people had to push into private equity and private lending and all these illiquid 5 to 7 year lockup investments. And that's kind of a fact, the endowment model that we've all read about. What happens now, though, and they also have calls on collateral that could be sitting out there. So if the market really does roll over and rates continue to go higher and equities continue to go lower, where are you going to get your cash? Where are you going to get your liquidity from? You can't really sell out of your privates. You'll take too big of a haircut. You don't want to sell out of your bond portfolios because some of the bond portfolios are not terribly liquid either, to tell you the truth. What you can do, though, is you can turn your equities into cash, your public equities. And cash is the ultimate put. Market crashes and you're sitting on cash, you effectively own an at-the-money put. But how do you prevent looking the fool? You just go out and you buy some upside calls. So that the market turns around and rips back up. That's about how I'm getting this area of skew is so flat, but vol is very fairly priced. And you could arguably say upside calls are too expensive. I'd love to hear people debunk me on that. Not that I want to get an argument, but that just goes back to being inquisitive about why is this going on? Like skew and VIX, they're just like gas gauges on the instrument of a car. Why are they saying that? It's almost, you almost have to go out and look under the car. Well, I mean, if gas tanks were made of glass, but you know what I'm saying? Like this anomaly should make you ask questions of why are we seeing this as something that hasn't happened in 35 years? This is the flattest skew I've seen since I've been in the marketplace. And I wasn't really in an inflationary environment. We didn't have VIX and we didn't have skew. Like you can't go back and look at 1975 through 1980 skew. I mean, there were no instruments or anything really accurate. It was pre-crash, right? We always blame fat tail option pricing on the crash. So is it really a rate-related thing?
As you think about your business and the environment, just in terms of the economic environment, financial innovation, are there any new products or mousetraps or where you see demand for innovation in the options-based portfolio construction side of things? What's on your mind there?
I feel that the most innovative things that we can do right now in the options space that drives more liquidity to it is have more products in the pipeline that people can understand. Going back to the, like I said, the 16 blow-ups that we had, we don't need more complex stuff. We don't need people solving the Rubik's Cube faster than the person sitting next to them. We need people using options to achieve a goal. I mean, listen, one of the longest running options firms in the business is Gateway Advisors out of Cincinnati, competitor of mine. The biggest and most successful portfolio manager in options in terms of gathering assets under management is Hamilton Reiner at JP Morgan Hedged Equity. He has $28 billion. Gateway's been around since 1986. I don't know why, as an industry, we don't look to follow their model. I mean, products that achieve a goal, not products that are volatility arbitrage. The guys at Simplify have done a pretty good job of rolling out their corridor ETFs. I know I'm advertising everybody but my own fund. But I love the fact that I talk to the guys I just mentioned, and I kind of view it as a coffee shop. Using options to achieve a goal is a coffee shop. I may have South American coffee, somebody may have African coffee, somebody may have something from Texas. Look, if people are in drinking coffee, that's great. We just need to drive people to be more open-minded about using options to achieve a goal. When I talk to RIAs and CIOs at endowments, foundations, and multifamily offices, the biggest problem I have is, what bucket do you go in? Oh, you're an alternative. No, we have long market exposure. Oh, go talk to the person in long that runs, and then I talk to them and they're like, well, how do you pick a stock? What's the PE ratio I don't do any of that. I just create a really good option hedge. Oh, you're an alternative. And then you go back to the hall. There's no meeting in the middle. And talk to anybody who's out there, any of the people I just mentioned, it is the hardest thing. You can have a great strategy, but if people don't want to if they're accustomed to reviewing a strategy based on what they know, and that's what they know, and that's what they're getting paid to do, as a business, I think we continue with new product innovation and everything continues to push down that kind of that alternative sleeve. And by the way, when you're in the alternative sleeve, you're in private equity, you're in guys buying 30 Burger Kings outside of Houston and all kinds of alternative lumber. We should be over in the equity bucket as a defensive equity or as a levered equity or in that sort of thing. So I don't want to say we need less innovation. I think we just need to refocus on how do we want to grow it. If you get 5 or 6 more JP Morgan hedged equities out there, now you're talking about $100 to $250 billion of options flow. That's going to create more liquidity. It's going to bring more people in, as opposed to if we go down the rabbit hole of I'm doing Nikkei corridor variance swap against VIX calls, because I think there's a basis arbitrage there.
It's good to hear the focus on transparency, liquidity, simplicity. I think ultimately these are about delivering a better product to the end user. All too often, unfortunately, there's too much product creation, right? These products are sold, not bought, is the old saying. I think that keeping it simple is probably a pretty good mantra going forward. Well, Dennis, it's been excellent to have you as a guest on our podcast. I've really enjoyed catching up with you and getting some of your stories on the past, but also learning about the product that you're working on now. And I wish you the absolute best in developing it and continuing to grow it.
Thanks, Dean. I really appreciate the opportunity to get up and talk.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.